Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Sorry we're starting a little bit late today. A lot of awesome technology that goes into making this show, as long as it works. Sometimes it doesn't. We've had a few gremlins recently we're working through. So anyway, this show is designed to be a live show. We answer questions. You can send those questions in during the show, and we can try to answer them live. And you can send them into the email address that you see here on the screen, asktom@talkmoneywithtom.com, or you can actually put them into the chat here on the channel if you'd like also. And we answer questions that came up during the week from clients, and actually we've had a lot of activity between tax time and all the stuff that's happening with the market with our clients this week too. So. And obviously, this channel is designed to try to help people with their retirement, especially the financial aspect of it. Lots of videos on here. You can go visit the channel. You can subscribe. You can put, the little bell notification will tell you when we put new content on, so you can look for that as far as that goes. And then you can just meet with us if you'd like to. If you have some specific questions that you want to ask, we're willing to dedicate a half-hour time to talk to you, Easton and I, phone, video, in office, whatever works for you. There's a book appointment button on our website. You can get to that through the link here on the channel too. So whatever works for you, we'll be happy to do that. We enjoy doing the show. So I'm going to start off, as I usually do, with kind of a summary of what's going on with the stock market right now, for this last week at least, to talk about, what we're seeing as far as that goes. So I'm going to switch over to the chart that we use, every week. So we've been looking at this for quite some time. You see that first dip that's right over that Talk Money with Tom logo there. That was the last time we did tariffs. It dropped 19.6%. What's kind of amazing about the drop that we've had so far, although it's faster, you can see it's a steeper piece, roughly the same amount of drop so far. The difference between those two time frames was that the magnitude, right? You're talking about a 10% tariff essentially on China originally. And so if you look at what happened, this week, we ended up at right now at 145% tariff on China, which for all intents and purposes is a blockade of Chinese products. And just today, China has announced 125% tariff on American goods coming into China. So obviously this week, they started off with this Liberation Day tariffs. Those got paused. The market skyrocketed on Wednesday, 9.5% because of that pause. Ended up dropping, 3.5% yesterday, because the reality is that when you look at the overall, what they call the net tariff, so if you take a look at the tariff for each country and then how much they actually import into the U.S., the net tariff was 22.7% after Liberation Day last week. And so now we don't have all of these retaliatory tariffs. We have a 10% tariff across the board. We have 25% on Canada and Mexico with a few carve-outs, to 25% on cars, imported cars and parts and what have you. But everything was given up except for the tariffs on China, and we actually raised those. So it's come up from 54% to 145% just this week. And now our net tariff, because China is such a big trading partner, is actually at 27%. So unfortunately, the actual tariff, the cost of these tariffs and what have you has up, even though there was a pause, a 90-day pause on all these other tariffs. So, Vietnam went from, I think, 46% tariff to 10%, just like everybody else. And so, that's good. But the overall, trading volume that we do with China is a problem. So we, last week, as we mentioned, we had a 63% exposure to the stock market for our average client across the board. We moved that down to 23%, and just getting out of the way of these big tariffs, and market was falling dramatically last week also on Thursday and Friday. There's been a total of $6 trillion that were lost just on those 2 days in the stock market. And then we've been looking for the news of these tariffs starting to lighten up or stop or change. And so the pause was good enough for us to move back in. We're currently almost 35% in exposure. So we're about half-ish where we were before, a little bit more. But That's not a bad spot to be right now, kind of splitting the difference. So the rest is in T-bills or ultra short-term bonds or short-term treasury ETFs. And we're just kind of wading through all of this stuff as far as that goes. Because the China tariffs are dramatic. I mean, actually, I saw an interview with a lady who runs a small business, 5 employees. She has what was $30,000 worth of goods. It's called Busy Baby. They make these little mats, sitting ready to go on the boat in China. But, with the tariff, all of a sudden it was going to be nearly 200,000. She's a little business. She's leveraged against her house, got these 5 employees, and they can't ship it. They can't afford it. They don't have the $200,000 to get to pay when it gets here. And so she said, we have 2 or 3 months worth of inventory. And, after that, we don't have any revenue. We won't be able to keep going. They talked about the possibility of, hey, maybe we ship this to Australia and then repackage it and ship it in with a 10% tariff that Australia has, which is kind of interesting thought process. But she said the biggest problem that they're running into is just the policy keeps changing about every 36 hours. And so making a big commitment. She said, we could try to make these here in the U.S., but we're about 6 months away from being able to do that with the tooling and what have you. And so if you look at that, that's a real life situation, and this is one small business and what's going to happen. But I think the thing that's interesting in there, it's quite dramatic, okay? You can't overcome this level of tariff, which to me means that these tariffs won't be here at some point in time, which is probably why you want to be half in the market. Because when they eventually have a situation where they get together and negotiate out some kind of tariff that makes more sense, the market will probably jump quite a bit. Matter of fact, it's up today. Trump is doing an interview today. It sounded better. He's talking about, he's waiting for the call from China. So it's kind of like who's going to blink first, who's going to call first. We're not willing to call China. China's not willing to call us. But somebody's going to call somebody at some point in time. Because you look at China, they were already in a situation, prior to these tariffs where, they've got huge property debt, lot of leverage in their property market, a lot of empty cities, actually kind of incredible, that have been built. And so there's been, ongoing problems in China. We can see it in the deflation that they've had. We can see it in the stimulus programs that they're talking about. They stayed locked down during the COVID piece, probably longer than most, and that created problems, and they're still trying to come out. So to take your biggest trading partner, which is us, and have a trade war, they're trying to do their best, but they have a big chance of blinking because this is going to be pretty tough to do. On the other hand, on our side, we're seeing all kinds of problems also. Matter of fact, the big story that came out about why the pause may have happened, on Wednesday, was because of the bond market. So Monday, Tuesday night, the bond market was really, really having troubles. And so the Treasury market is the most important piece of this whole puzzle. We're looking at the stock market here. It's very important, but nothing. I always talk about how, like, in relative size. So if the stock market is a baseball, the bond market is a basketball, right? It's significantly bigger. But more than size is the importance. We can't pay our bills if we can't sell new treasuries. So we did have a treasury auction this week. It went okay. This was after the pause. But when you start to see all of these currencies doing better than us at once, that usually means that foreigners are selling our bonds. And if you raise tariffs really high, one of the problems that happens there is that foreign companies will often sell to us, get U.S. dollars, and sometimes want to keep those dollars, and they'll park it in treasuries. And so if we have a large budget deficit, which we do, we have to continuously put out bonds to be able to sponsor that deficit. If we can't sell bonds, that house of cards really falls apart. And so, that's, to me, that I watch the Treasury auctions and the Treasury market really more than most, just because I think that's the key thing. We've always bailed ourselves out of all these problems by basically, doing these stimulus bills and all these different things that we've done. Well, that takes money, which takes, selling these bonds. And so the other part of this that's quite important is that there's 9.6 trillion, roughly a third of our debt, that comes due in June. So we're going to have to issue a massive number of bonds to be able to pay those old bonds off. And obviously, one of the problems is that the old bonds we're paying about 2.7% on. That's what the article said, and the new bonds, are obviously going to come out at higher rates. And they've been trying to bring rates down, and maybe that's even why we're doing some of this craziness. But now rates are going up,
Yep.
and they went up a lot this week. Because of the fear of the U.S. Is it a safe haven anymore? Should we keep money there? China has, depends on the article I read, someplace in the $600 to $800 billion worth of U.S. debt. It used to be much higher. They've moved down. But China looks like they might be selling some of the bonds also. And one of the articles I read said it's because not so much as a strategic threat, it's because they have to, and they're getting ready to absorb and to support their industries that might be affected by this big tariff in the U.S. So all of this stuff, in my opinion, is going to lead to a situation. I mean, it could be tomorrow for all we know, over this weekend. It can't be too long, though. Mm-hmm. It can't be a month from now. Maybe it can. You look at that busy baby, this CEO, she's talking about having 2 or 3 months worth of inventory to sell. Every place probably has something that they can keep going with before they're going to hit some real potholes. But in essence, you're going to bring the whole house down if you keep that tariff there. I think both countries kind of know that.
Yeah, it's kind of like a term that's used in nuclear war is called MAS, mutually assured destruction.
Yep.
And that's kind of like what they're talking about, the MAD, like principle. Like, is China and the U.S., with this tariff war, going to basically destroy each other?
Yeah, because, I mean, this is a global economy. You can't have the second biggest economy in the world, this being China, fall apart and then not affect us, right? Or not affect the rest of the world, and not affect Europe, not affect South America. And so, you're pushing this country to the brink, trying to get them, to negotiate. And I think they will, but if they don't, we're not going to come out. It's mutually assured destruction. It is. And so I think there's, awareness on both sides of that. Sometimes it takes that extreme, like on Wednesday when they did the pause and the bond market's falling apart. And that seems to be, I heard one quote where, and I don't know if this is even true, but what Trump was talking about, I'm okay with causing a recession. I don't want to cause a depression. If that's a true quote, it's actually a little bit disturbing because I'm not even that confident that, we should be having a recession personally, especially since we were doing so well before. And, one of the problems that we're having here is what's the outcome? What are we trying to accomplish here? So we get all these tariffs. It brings in this revenue, supposedly. They're probably going to get less revenue than they think because when you raise prices, the demand drops.
Yeah, demand destruction.
Yeah, demand destruction. But let's say they do get money. Where's it going? We don't know, right? And so it'd be nice to know some type of a plan. It would create some confidence. But again, the market is going up today. If you can see the chart there, that's a weekly data. This week is up, versus the last several weeks. Is this a real return? These tariffs have been paused for 90 days. That gives them a chance to get some negotiations in. That sounds good, but we really have to solve the China problem as far as that goes, and somebody's got to call somebody, to make this start to happen. So anyway, that's what's going on. Like I say, we're about half-ish back in from where we were before. That's going to be different for all of our clients. Some clients are going to have more exposure than others, just because, it's not even. Big chunk of what we did not sell was highly appreciated, assets that clients had. Some people don't have any of that. Some people have a lot of that. So, but just to kind of understand, what we're thinking about. And again, we're looking at this not so much from what the market's doing, which is what we normally do, just because this is a manufactured crisis. And it was manufactured by putting these tariffs into place, and maybe even the way that they were done, the speed that they were done, the way that they were calculated, all these things. But nonetheless, it can also be taken away really quickly. And it makes very, very difficult time frame to see what's going to happen. And it's actually a really dangerous gambit, as we saw on Wednesday when the bond market started to implode. And, they're playing with fire. I'm not sure anybody knows how everything is connected. It reminds me very much so what happened in 2008. We were down 27%, and Lehman Brothers is coming, begging for a bailout. 150 billion, I think, was the dollar amount. We had just bailed out Bear Stearns literally the week before. Did not bail out Lehman Brothers, and the Treasury Secretary and the Federal Reserve Chairman, or neither one of them knew the ramifications, and these people should know, but didn't know about these credit default swaps, these insurance policies, and how many had been sold that were put on top of these mortgages, which were all starting to fail. And basically everybody had to sell everything. And so when you do what we're doing right now, that is the danger. And that's why you want to be at maybe a 50-50 spot here, just because something could break. It could break pretty quickly. It could be kind of dramatic, whatever that might be. And it's probably not something we're even talking about. That seems to be what really creates a lot of the biggest downturns, is something that we're really not discussing. It's hard to see. I mean, we're talking about this basis trade. Apparently there's almost $1 trillion of money in these leveraged hedge funds doing a trade against Treasury futures versus Treasury bonds, basically trying to scoop up a little bit of a differential there as far as that goes. And so you're unwinding that, you're selling off your Treasury. So, these are things that are, very difficult to see. Sometimes they're private transactions. I mean, they didn't realize that there was $7 trillion worth of credit default swaps in 2008, and most of those had been done in about a 5-year period, and so money can move into things very quickly. And so anyway, that's where I'm optimistic actually that in the short term, next week, the week after, we'll probably have some better results out of China, at least with that tariff, because it needs to happen. If it doesn't happen, we'll probably be glad that we're half out, because of these situations. You take this busy baby, and that CEO and what she's saying, and multiply that times all of these businesses that are out there selling things, and on top of the extra cost that's going to come through, it's not a good situation for the economy as far as that goes. So anyway, that's where we're at. I think that so far we're looking at a negotiating strategy as the best positive outcome that we can have out of this. So we'll see if that's true or not. But we're waiting like everybody else to see what happens. Let me go back to, there we go. So anyway, that's a summary for the week. Again, watch for the China story. That's the key right now. It's what everybody's really focusing on. I thought today's interview that Trump did was better. I thought he was softer about that. He's looking at it. He's talking more. It's not so much the bellicose thing that we've seen in the past. I think he's interested in trying to make a deal. And again, he doesn't want to lose face by calling, and Xi Jinping doesn't want to lose face by calling. So at some point in time, somebody will hopefully, calmer heads will prevail here, and we'll get something out of that. So anyway, that's what's happening this week. We'll be here again next week. We can talk about what's happening with the markets. But let's start off with our first questions.
So the dollar versus other currencies, as measured by the DXY index, has been rapidly plummeting recently. It's now at a 3-year low, level we haven't seen in a long time. How does the falling dollar affect other asset prices like stocks, bonds, gold?
Yeah. Okay, a couple things. There's been a lot of talk about the falling dollar. Most of the chatter has been around that being good for U.S. exports, right? So if somebody has a retaliatory tariff against us, and it's a 10% tariff, and the dollar drops 10%, we can still sell that product essentially at the same price.
Yeah, because they're going to be buying with their currency.
Yeah, exactly. So, how it affects other asset classes, we do get a chart. We got this question. Let's see. Let's keep going.
Oh, you go switch onto the screen.
Oh, I got it. There it is. There. All right. So we made this chart. Just the green line there is the S&P 500 year to date, right? So that's down 8.6% year to date, which by the way, isn't that much for all the news and all the concerns that we've had? The S&P is, it was down more. You look right over my head there; it was down quite a bit. We had that 9.5% jump, on Wednesday that really has helped a lot. And so let's compare that. So if you look at the dollar, it's down, or at least as it represented by DXY, which is the dollar against a basket of currencies, is down, 8.2%. So pretty much the same as the S&P 500. Whereas the bond market, using BND, which is the Vanguard Total Bond Market Index ETF, BND, that's up 1.1%, for the year to date. Here we are, middle of April. And then gold, of course, has gone up quite dramatically. That's up 21.5%. And you can see actually gold has had a very direct, negative correlation to the stock market for all intents and purposes. Mm-hmm. It went up when the market was really going down. And so, how does the falling dollar affect other asset classes? It's a pretty good question. I mean, if you're looking at it as a foreigner, right, and the dollar's coming down and you have U.S. stocks, you're making money on that, right? Because, U.S. stocks are down, but let's say the U.S. stocks were flat. If the dollar dropped 8% against your currency and you made nothing on the stock market, you'd still make 8%, mm-hmm. right? And so that attracts dollars that come into the situation. If you already own a U.S. asset, it's a problem.
Yeah.
Right? So think about that. So if I am a foreign buyer of treasuries and I'm going to make, 2 to 5% on those treasuries, whatever it is, however long I've held on to that, and all of a sudden I'm losing 8% on my currency exchange, I'm losing money. And unfortunately, that's a real big problem for treasuries. So I think that's probably the biggest impact, is that you have some hope of making more on those stocks because they average close to 11%, whereas you look at the overall bond market, it's kind of in that 5.5% range on mm-hmm. long-term averages. And so if I have massive currency fluctuation and the dollar's coming down, the dollar's usually pretty stable. It's usually pretty, strong. So like it says, the 3-year low, I might be selling some of my treasuries because I'm taking undue risk mm-hmm. on a product that's not going to get me, an 8% return. And I might not do so if I'm going to, feel like the dollar's coming back. But you're also actually contributing to the fall of the dollar when you're starting to sell those treasuries. Right?
Yeah, it's kind of a snowball effect.
It is. And so I think that's probably the biggest impact, is to the treasury market when the dollar starts to come down. But I'm not sure, chicken and egg, right? I mean, are you selling treasuries and that's creating a dollar decline? I think probably the dollar decline is the beginning of this situation, and it has a lot to do with confidence that people have, in the country. I think confidence is dropping off. The safe haven aspect of it being in the U.S. is dropping off here. We're kind of burning up a lot of, goodwill that we've had for quite a while, but that, we'll see. Sometimes that can be temporary, as far as that goes. But it's a really good question. I would say that the overall treasury market is probably, taking the biggest hit from this, and the dollar coming down and down and down. Again, it's nice for an exporter, but there's other ramifications.
Yeah, so importers pay more, and it's kind of similar for commodities in the sense that producers will benefit from if the dollar is weaker because commodity prices go up if they're doing it, because if a commodity is traded in other currencies, it has to be equal. Yeah. And so to equal out, it has to go up in price. But that means input costs for manufacturers will go up if commodity prices go up. Yep.
Okay, we'll switch back to the... All right, so what's our next question?
So why are the Treasury auctions so important to the U.S.?
Okay, yeah, that's a good question, actually. And again, it's something to really focus on. There was some concern this week that we'd have trouble. They had the 5-10-year Treasury auction that happened, but it did really well. And part of that is because the yields were going up, right? So again, with bonds, when the price goes down, the yields go up and vice versa. So if they were selling at 4% and all of a sudden they're at 4.5%, more people are interested at 4.5%. So ironically, the trouble we were having in the Treasury market actually has increased the interest in those treasuries. But they're critical. And we had over the last couple of years a few instances where they had some issues with the Treasury auction. But most of the times it works really well. And the reason it's important is because we run a deficit. So if I have $1,000 worth of bills to pay, and I'm bringing in $700 of revenue just normally, I'm having to borrow $300 every month to pay my bills. Okay, not the greatest concept ever, but as long as I can continue to borrow, I'll be able to pay my bills.
As long as people see you as trustworthy.
Yeah, exactly. As long as somebody says, hey, I'll give you $300 every month to pay your bills, essentially, I can do that. But when all of a sudden, when whoever's lending me money says, no, we can't do that anymore, I now can't pay all my bills. I'm going to have to not pay $300 worth of my bills. So that's what the government faces here. So, there's some attempts here, obviously, to reduce the size of the government and the amount of outflow that's going out. But it's very unlikely that they can reduce it enough to get rid of the deficit that we have. And so they have to issue these treasuries to be able to pay the bills. And it's critical. And then, we've done all these different stimulus programs, for example, that started in 2008 with the whole concept of just sending money out, basically. And we had TARP and TARF and all these different things that started. And then, of course, 2020, lots of stimulus money went out to businesses, to households. That's all, we're selling treasuries in order to finance those things, right? And so that's critical as far as that goes. And if you think about it, most of the times when we have to sell the most treasuries are times when things are falling apart. And because we're doing these bailout situations, and assuming we continue to do those, which, they seem to be quite effective, and politicians are looking at the next election, which isn't that far away, and so oftentimes we will probably continue to see these stimulus type things come out. And the one advantage the U.S. has and has had is that, we are a safe haven, right? And so people are running with their money into our treasuries. And at the same time, we are trying to sell more to create all of these different stimulus pieces. So that's where it's also important that we continue to have that level of trust. So in my example where I had $300 deficit that I was having to pay, as long as I'm trustworthy to whoever's lending me the money, I can continue to do that forever, theoretically. And the problem would change dramatically if somebody all of a sudden didn't see me as trustworthy. And so that's kind of where the damage for some of these trade wars comes in, and we got to be a little bit careful with that. But that's why treasuries are important. It's the key. It's the critical aspect. It's the one thing I probably watch no matter what, is that treasury area, because I think it's the most important piece. Because someday we might not be able to do some of these bailouts, and then we'll kind of have this kind of house of cards come down in an unexpected, unplanned, chaotic way. So, so far so good as far as that goes. So we'll see. All right, what's our next question?
So, what are tariffs, and who actually pays the tariffs?
So tariff is basically a tax on goods, I guess would be the way to do it. It's kind of interesting because we sell a lot of services, and for some reason we're really focused on these goods. And over time, services have started to really take over goods as an importance to the economy as a whole. But so if a good is made outside of the U.S., which most are, even things that are made in the U.S. are still made with pieces of parts that come from other countries oftentimes. So if that part or whole completed piece is coming in, there's a tariff. So let's take an example of a $1,000 iPhone. So theoretically, and again, I'm simplifying this dramatically because actually the tariffs are really complex and they get into each little market as to how much it's going to be. But let's just say it's 145% tariff. Right, that's a $1,000 iPhone has got $1,450 of tariffs, right, at 145%. And so who pays that? Somebody pays that. Does the manufacturer in China for that, Foxconn or whoever's putting that together, do they eat some of that? Maybe, some. Then you get to Apple. So does Apple then, let's just say nobody's paying it and Apple decides to pass the whole thing on to a consumer. So now the $1,000 iPhone is $2,450. All right. Well, how many iPhones are you going to sell at that price versus how many you could have sold at 1,000?
Yeah, because Apple doesn't get any of that tariff money.
No.
So any of that price increase, usually in normal markets, when you increase price, at least your profits go up.
That's right. So, it's the old econ thing 101, guns and butter and this whole supply demand thing that we all learned. And so what happens there is that, when we go to 2450, let's just say they just raised their prices. There was no tariff. Well, they're getting more money even though they're selling less, units, because there's less demand at that price level. And all of these companies are trying to find that price level where, they can sell the most units for the most profit, right?
Yeah, they're trying to maximize their end result.
But the problem with the tariff is that they don't have control over that. That $1,450 is not theirs. And so they're going to raise the price whether they want to or not. So then you can go the other way. Let's just say they keep selling at $1,000. They probably sell a lot of phones. They might even sell more because competitors are going to have a hard time matching that. However, they're probably not going to sell enough to offset the $1,450 if they were to pay it all themselves.
Yeah, because if you're selling for $1,000 and you have to pay a $1,450 tariff, you're losing $450 per phone.
Yeah, that would be bad, right? I mean, more phones you sell, the worse it gets. And so, and of course, the price of a stock like Apple is based on its earnings, and that could really have a very detrimental effect on the earnings. So, again, if this is a negotiating tactic and we get down to a 10 to 25% tariff, those are, we have sales tax here that's nearly 10% here in the county. So, it's something that's not good. It does suck money out of the economy, and I think that is another piece of it that's not been explained. Where does the tariff money go? Does it come back into the economy somehow? So maybe Apple suffers, but the economy still does well because the money comes back around. That hasn't been explained in my opinion. But that's how a tariff works. Who pays it is it depends. From what we saw in the previous tariffs, there's kind of a split between the company, the importer, in the most case, paying some, and some of it being passed on to increase price, so the consumer's paying some of that. But 145% it's crazy. I mean, there's no way. Like you just said, I mean, they'd be losing money on every iPhone if they absorbed all the money themselves. So they have to pass some of that along.
Yeah, so I don't think any business will have an ability. It could just stop their business completely, like the baby mat business. Basically, they're frozen. If they had a contract where they needed more mats, they can't take that contract on. They're basically stuck with what they have and their existing means. Yeah,
and that's a great example because Busy Baby was just interviewed, and basically CEO's talking about $30,000 worth of goods ready to get on the boat. All of a sudden now it's almost $200,000 worth of goods. And so who's paying the tariff? She is, right? In order to get this on the boat. She doesn't have $200,000, but she's not going to be able to absorb all that either. She's going to have to increase the price of her baby mats just to stay in business also, right? Mm-hmm. But she can't even get it here. She doesn't even have the money to get it here. So that's why this is a lockup. I mean, it's basically a blockade of Chinese products for all intents and purposes, to the point where, that's why I think it'll be settled, right? I mean, maybe I'm wishful thinking, but it's mutually assured destruction otherwise. And so, you get the Cuban Missile Crisis situation where you're going to get pretty close. But I do think they'll be settling this. But that's what the tariffs are, and that's who pays tariffs. It's an interesting area, right?
Yeah, and tariffs have been used for years. They've always been to protect domestic industries or to generate revenue.
Yeah, exactly. But our average tariff was 6%. On incoming goods, and now it's up to 27% if we keep tariffs where they are with China. Mm-hmm. And that's just such a big jump, 21% jump on average tariff, that, it's pretty destructive as far as that goes. And we have had tariffs. Other countries have tariffs. Tariffs are not the end of the world. It has to do with magnitude. It's like anything else. Anything in excess can be, even healthy things. If you eat too many carrots, your skin's going to turn orange. Mm-hmm. The carrots aren't bad for you. But, so it's just that kind of thing. So that's what's going on with tariffs. All right. What do we have for another question?
So what happens if treasuries are no longer a safe haven?
Yeah, that's a good question. In the next big downturn, whatever that is, when we go out to try to bail out that downturn, we are going to be selling a lot of treasuries because we don't have excess money laying around. We're running a deficit already.
Mm-hmm.
Like I said, if I have $1,000 worth of bills and I have $700 coming in every month, I've got to, find and sell a loan. I got to get a loan for that extra $300. That's what the government's doing. When they sell these treasuries, they're getting a loan. It has a date that it's going to be due and an amount of interest that they have to pay depending on the length of the treasury and what have you and the time that's issued. But so it's critical, even on a day-to-day basis, to be able to sell treasuries, but even more so in a downturn, because in a downturn, revenue is going to drop, right? Mm-hmm. Unemployment's going to go up. Companies are going to make less money. They're going to be paying less taxes. They're going to hire less people, which means less taxes from individuals.
Yep.
All of these things, and the government's bills are actually going up in a time when their revenue is going down. And so just in a normal time frame, without any stimulus or anything else, they need to be able to sell treasuries. And the advantage that the U.S. has had is that we are a safe haven. And, you look at the U.S., we got all kinds of issues and problems and things that are going on here. But it's sort of like the story of, the bear is chasing you and some other people. You just have to be able to outrun those other people. You don't particularly have to be able to outrun the bear. And so, we outrun these other countries as a safe haven. Some of that's being called into question now because of this tariff war. I'd say, who are you going to go to, really? With this, with especially with the world and all the money that comes flooding out in these big crisis situations, I still think the U.S. is one of the safe havens. There are countries that are better. You look at Switzerland and different places like that. They're just not big enough to absorb,
Mm-hmm.
The total weight of this, safe haven concept. But it is a really important component. It is one of the reasons why we have diplomacy and we try to stay, because you're basically selling, we have to sell these treasury bonds to somebody.
Mm-hmm.
And, you and I, Easton, we don't have enough money to go out and buy enough treasury bonds to save, and individuals, even as a group, all of our clients can't save the treasury market. It's a worldwide issue to be able to kind of continue to have money coming into U.S. treasuries. And that is one of our huge luxuries. And so losing that would be a problem.
And being basically having a trade deficit also creates a market for the treasuries.
Yeah.
Because a lot of people, they just park their money in U.S. dollars.
Right.
It's just easier that way. And treasury is a great way to park your money and
Yeah.
just have it there and get a little bit of interest.
That's a good point. So trade deficits are seen as evil by some people, but in this particular case, when you're trying to sell treasuries, again, a deficit means that they're selling more products to us than we're selling to them, and that means they're ending up with more dollars than we are ending up as a whole with that foreign currency. And some of those dollars are parked into, they want to keep it in dollars, and so they park that into U.S. treasuries, and it is one of the cash flows. And so again, if you raise tariffs a lot, you're going to have less of that cash flow coming into the market too. And so part of being a safe haven is that it's not just an image, it's also the fact that the treasuries are doing well. And what we had this week, at least at the beginning of the week, was a treasury market that was really kind of unwinding and having some problems. Who wants to go into that on top of a falling dollar if you're outside the U.S.? That's going to make for a market that is less likely to be seen as a safe haven, right? So, good. All right, let's go for another one here.
So, why are U.S. Treasury yields rising as the stock market fell? Usually, yields kind of fall as people run towards treasuries.
Yeah, last week on the show we talked about like one of the hedges that you could use, and was the long-term treasury, right? And we showed a chart: stock market going down, long-term treasury going up. Now, that's the relationship that we're used to. This week, Monday, Tuesday, Wednesday, big sell-off, especially in the long-term treasuries, but all the way across all of the bond market and all of the treasury market. And it's supposed to be going up again when the market is going down. But there's lots of different reasons that things can be going up. One thing is we're seeing, the dollar fall. So that often means when you look at these other currencies gaining strength, the euro, Canada, whoever it is, means that the foreigners are selling our treasuries.
Yeah, essentially the demand for U.S. dollars is going down, and
Right.
they want to convert over, and so
Yes.
that goes up.
That's right. Uh, there's probably there's a thing called the basis trade, which is a highly leveraged scenario that is often used with these hedge funds. One article I read said there's almost $1 trillion in the basis trade within these hedge funds. And when you unwind that, basically what it is, they've got a treasury future versus a treasury bond, and they're kind of playing an arbitrage game between those two. There's not a lot to be made, but if you do it on high leverage with big dollar amounts, it can add up. I've seen so many of those type of things blow up over the years. It reminds me of that leading edge capital piece that almost brought the whole world down back in, I think it was 98. Anyway, where they try to find very small discrepancies, but they use massive leverage to try to make that into a really good rate of return.
Yeah.
But when that starts to fall apart, you unwind that, and unwinding that means selling these bonds. And so there was some words about that. China has 600 to 800 billion. They probably need to sell some of those. They obviously might be doing that as a retaliatory effort, but they probably need to gather up as much money as they can if they're going to try to do this trade war for any period of time, just to be ready. So, anyway, that's been the explanations that have come out for the most part. Can you think of anything else for kind of what's been out there? We got the foreigners selling. You got the loss of safe haven aspect of it. You have this unwinding of this basis trade.
There's hedging too, right? And so they could be de-risking away from bonds because of the rates.
Yeah, that's right. So should be going up. I mean, this week we had CPI. It came out better than expected. And when the CPI, the inflation gauge, comes out better, that means there's some chance, without the tariffs anyway, of lowering of interest rates, and that would be good for the bond. So a lot of times when you saw, CPI, coming out good in the past before all this tariff stuff was happening, we saw a big jump in the bonds. We're not seeing that. So there's obviously something else going on here, because the bonds are not, stock market's coming down, bonds should be going up. It's not. We're seeing inflation, a good number come through, bonds should be going up. It's not. So there's outside forces that are coming in here and really messing with the bond market. It was down today too, a fair amount when I was watching before the show also. So, we'll see how things play out. But it's an area, I guess in the end, it's kind of the guardrail. That's what caused this pause, caused everybody to step back, probably could cause the negotiations to kick in for China. We can't afford, as a country that needs to issue these bonds, a bad bond market. Now, we did have a treasury auction, it went okay, but you're risking that not going okay. So, again, they're playing with fire here. Hopefully they can, get to where they need to go before it's too late. All right. Okay. Let's wrap it up there. Again, I'm sorry we started late, so we finished a little bit late. Try to give you what we can here. So again, feel free to send in questions. Send them in during the week. Send them to this email address, asktom@talkmoneywithtom.com. Love to answer those. Also, feel free to subscribe to our channel, hit the bell button. There's a lot of educational content on the channel as a whole. And then, of course, if you just want to talk to us, go ahead and click the book appointment button that's on our website. The link for our website is on this channel. We'd be happy to talk to you then, too. So thank you very much for coming. I look forward, again, to being able to talk to you again next week. We'll do the normal, daily videos, and we'll be here to do the show next Friday. All right? This is a pretty good time to be kind of paying attention as to what's going on. So thank you for coming. Again, we'll see you again next Friday.